All right, John OG here, and I need you to lock in for the next few minutes because what I'm about to share with you is not speculation. It's not theory, and it's not another generational wealth narrative that you can ignore. Over the next 25 years, $84 trillion in wealth is going to transfer from baby boomers to their heirs in what economists are calling the Great Wealth Transfer. That's not a projection. That's a mathematical certainty based on demographics, life expectancy data, and the largest concentration of wealth in a single generation in human history. But here's what nobody is telling you. 70% of wealthy families lose their wealth by the second generation, and 90% lose it by the third. That means of the $84 trillion being transferred, nearly $60 trillion will be destroyed, squandered, or confiscated through taxes, bad investments, and financial illiteracy within 2 decades of the transfer. This is not about inheritance. This is about the largest destruction of generational wealth in modern history happening in real time, and the opportunities it creates are asymmetric beyond anything we've seen since the Great Depression. And here's the part that makes this urgent. The transfer is already happening. In 2024 alone, over $3.2 trillion changed hands from boomers to their heirs through deaths, early gifting strategies, and estate planning. That number is accelerating every year as the boomer generation ages. By 2030, we will be at peak velocity with over $5 trillion per year transferring. And by 2045, the entire $84 trillion will have moved from one generation to the next, fundamentally reshaping who owns what in America. The wealth extraction mechanisms are already in place. The tax code is written to capture 30% to 50% of large estates. The financial services industry has built an entire business model around managing inherited wealth at fees that compound into massive destruction over time. And the real estate market is about to be flooded with supply from heirs who don't want their parents' homes and need liquidity to settle estates. If you understand what's happening, you can position yourself on the right side of this transfer. If you don't, you'll either be one of the heirs who loses everything or one of the investors who watches the opportunity pass by while waiting for permission from the mainstream media to act. Over the next 28 minutes, I'm going to walk you through exactly how this wealth transfer is structured, why most heirs are mathematically guaranteed to lose their inheritance, and the 3 specific plays you need to understand right now to position yourself on the receiving end of this massive wealth redistribution. By the end of this video, you will have a framework that 99% of financial advisors aren't discussing with their clients because they don't want you to know that the system is designed to extract wealth from unprepared heirs. I'm going to show you the exact tax mechanisms that confiscate 40% to 50% of large estates before heirs even receive the money. I'm going to break down the behavioral patterns that cause 70% of heirs to squander their inheritance within 10 years. I'm going to reveal the forced liquidation dynamics that will flood the real estate market with supply over the next decade. And I'm going to give you the specific playbook for acquiring cash-flowing assets, businesses, and properties at 30 to 50 cents on the dollar from heirs who are desperate for liquidity and have no idea what they're selling is worth. This is not about taking advantage of people. This is about understanding that wealth transfers from those who don't value it to those who do. And if you're not positioned to capture your share of this redistribution, someone else will be. So turn off the distractions, grab a pen, and let's break down the largest transfer of wealth in human history and why it's about to create the greatest buying opportunity of your lifetime. The baby boomer generation, Americans born between 1946 and 1964, currently controls approximately $78 trillion in wealth. That represents over 50% of all household wealth in the United States, despite boomers making up only 21% of the population. This concentration happened because boomers lived through the greatest period of economic expansion in American history. They bought homes for $30,000 that are now worth $800,000. They bought stocks in the 1980s and 1990s at valuations that will never be seen again. They benefited from defined benefit pension plans that no longer exist, and they accumulated wealth during a 40-year period of declining interest rates that inflated asset prices across every category. Let me break down exactly what that $78 trillion looks like because the composition matters. Approximately $28 trillion is in residential real estate, homes that were purchased decades ago for prices that seem laughable today. A boomer who bought a home in San Francisco in 1975 for $50,000 is sitting on an asset worth $2 million today. That's a 40x return driven not by improvement or development, but purely by inflation, population growth, and restrictive zoning that limited supply. Another $35 trillion is in financial assets, stocks, bonds, mutual funds, 401ks, and IRAs. Much of this was accumulated during the greatest bull market in history from 1982 to 2000, when the S&P 500 went from 100 to 500, a 15x return in 18 years. Boomers who were disciplined savers and invested consistently through that period saw their retirement accounts compound into 7- and 8-figure balances. The remaining $15 trillion is in privately held businesses, farm and ranch land, collectibles, art, precious metals, and alternative assets. This is the wealth that is hardest to value and hardest to liquidate, and it's the wealth that creates the biggest opportunities for distressed buyers when estates are settled. Now that generation is aging. The oldest boomers are turning 80 in 2026. The youngest are 62. The average life expectancy for an American boomer is 78 to 82 years, depending on health, income, and geography. That means the oldest cohort is already in the mortality window, and deaths are accelerating every year. In 2020, approximately 2.1 million boomers died. By 2030, that number will exceed 3 million per year. And by 2040, we will be at peak mortality with over 4 million boomer deaths annually. And over the next 20 years, the vast majority will pass away, triggering the largest intergenerational wealth transfer in recorded history. According to research from Cerulli Associates, $84.4 trillion will transfer from boomers to Gen X and millennials between 2024 and 2048. $72.6 trillion will go to heirs, and $11.9 trillion will go to charities. But let's be clear about what transfer actually means, because the word makes it sound orderly and planned. In reality, most of this transfer will be chaotic, unplanned, and value destructive. According to the National Association of Estate Planners, 68% of Americans do not have a will or trust. Among those who do have estate plans, 40% have outdated documents that don't reflect current tax law, current asset values, or current family situations. This means that the majority of the $84 trillion will transfer through probate, which is a court-supervised process that is slow, expensive, and public. Probate can take 12 to 18 months to complete, during which assets are frozen, businesses can't be sold or transferred, and heirs have no access to liquidity. Legal fees, executor fees, and court costs can consume 3% to 7% of the estate value, meaning billions of dollars will be extracted by attorneys and administrators before heirs see a single dollar. That's $72.6 trillion landing in the hands of people who, in most cases, have never managed significant wealth, have no experience with estate planning, and are about to be targeted by every wealth extraction mechanism in the financial system. Financial advisors charging 1% to 2% annual fees. Tax authorities looking to capture estate taxes, capital gains taxes, and income taxes. Real estate agents and brokers taking commissions on forced asset sales, and an entire industry of wealth management, legal services, and financial products designed to extract as much value as possible from unsophisticated heirs. But before we get into the extraction mechanisms, you need to understand the historical pattern of wealth destruction across generations, because this is not new. This is a cycle that has repeated itself in every society, in every era, throughout human history. In 1889, Andrew Carnegie published an essay called The Gospel of Wealth, in which he argued that inherited wealth was a curse, not a blessing. Carnegie observed that the children of wealthy industrialists almost universally squandered their inheritances within a single generation because they had not developed the skills, discipline, and mindset required to preserve wealth. Carnegie's solution was to give away his fortune to libraries, universities, and charitable foundations, rather than pass it to his heirs. Carnegie was right. Studies of wealthy families over the last century confirm that 70% of families lose their wealth by the second generation and 90% by the third. This pattern is so consistent that it has a name in Chinese culture. Wealth does not pass 3 generations. The first generation builds the wealth through hard work and sacrifice. The second generation maintains it but begins to take it for granted. The third generation destroys it through entitlement, poor decisions, and lack of financial education. The Williams Group, a wealth consultancy firm, conducted a 20-year study of 3,200 wealthy families to understand why this pattern repeats across cultures, time periods, and economic systems. Their findings were unambiguous. The primary cause of wealth destruction is not economic downturns, bad investments, or unforeseen catastrophes. It's the failure to prepare heirs for the responsibility of managing significant capital. Of the families studied, 60% attributed wealth loss to a breakdown in family communication and trust. When parents don't discuss money with their children, when estate plans are kept secret, when heirs have no understanding of how the wealth was built or what it represents, the result is predictable. The heir receives the money, has no emotional connection to it, and treats it as disposable income rather than intergenerational capital. Another 25% of wealth loss was attributed to inadequate preparation of heirs. Parents who spend decades building businesses and investment portfolios often spend zero time teaching their children about financial literacy, investing, tax planning, or business operations. The heir inherits millions, but has no framework for managing it, so they delegate to advisors who extract fees, or they make impulsive decisions that destroy value. The remaining 15% of wealth loss came from failure to have a mission or purpose for the wealth beyond just passing it down. Families that survive across generations have a clear articulation of what the wealth is for: building businesses, supporting education, creating philanthropic impact, or preserving land and resources. Without that mission, wealth becomes just a number in a bank account, and numbers get spent. The mechanics of this wealth destruction are predictable and measurable. The first mechanism is taxation. When a boomer dies and leaves an estate worth $20 million, the federal estate tax exemption in 2026 is $13.61 million for an individual, or $27.22 million for a married couple. Anything above that threshold is taxed at 40%. So if the estate is not structured properly with trusts, gifting strategies, or charitable remainder trusts, the IRS takes 40% of the excess immediately. Let me walk you through a specific example because the numbers are staggering when you see them applied to real wealth. Imagine a boomer couple who built a successful manufacturing business over 40 years. They own the business, which is valued at $15 million. They own their home, which is worth $3 million. They have $8 million in retirement accounts and taxable investment accounts. And they own a rental property portfolio worth $4 million. Total estate, $30 million. When both spouses die, the estate tax exemption is $27.22 million. The excess is $2.78 million. At 40%, the estate owes $1.11 million in federal estate taxes. But that's just the beginning. The business has to be valued by an appraiser, which costs $50,000 to $100,000. The estate has to go through probate, which costs another 3% to 5% of the gross estate, or $900,000 to $1.5 million in this case. Legal fees, accounting fees, and executor fees add another $200,000 to $500,000. Before any assets are distributed to heirs, the estate has already been reduced by $2.3 million to $2.7 million, or roughly 8% to 9% of the total value. And we haven't even talked about the taxes the heirs will pay when they take distributions from the inherited IRAs or sell the business or rental properties. But estate taxes are only the beginning. When heirs inherit assets, they receive them at a stepped-up cost basis, which means the cost basis resets to the market value on the date of death. This eliminates capital gains taxes on appreciation that occurred during the decedent's lifetime. But the moment the heir sells the asset, any new appreciation is taxable as capital gains at rates of 15% to 20% at the federal level, plus state taxes in many jurisdictions. Then there are income taxes on retirement accounts. If the heir inherits an IRA or 401k, those accounts are subject to required minimum distributions, and every dollar withdrawn is taxed as ordinary income at rates up to 37%. The Secure Act of 2019 eliminated the stretch IRA for most beneficiaries, requiring non-spouse heirs to withdraw the entire balance within 10 years. This forces distributions into the heir's highest earning years, maximizing the tax burden. Here's a concrete example. An heir in their 40s earning $150,000 per year inherits a $2 million IRA from their parent. Under the Secure Act, they have to withdraw $200,000 per year for 10 years. That $200,000 is added to their $150,000 salary, putting them at $350,000 of annual income. At that level, they're in the 35% federal tax bracket, plus 10% to 13% in state taxes in high-tax states like California or New York. The effective tax rate on the IRA distribution is 45% to 48%, meaning the heir nets $104,000 to $110,000 per year instead of $200,000. Over 10 years, instead of receiving $2 million, they receive $1.04 million to $1.1 million, and the government takes $900,000 to $960,000, nearly half. Add it all together, and between estate taxes, capital gains taxes, income taxes on retirement accounts, probate costs, and state taxes, the effective tax rate on a large inheritance can exceed 50% if the heir is not advised properly. Half of the wealth disappears to the government and the legal system before the heir even decides what to do with it. The second mechanism is forced liquidation. Most boomers hold their wealth in illiquid assets: real estate, privately held businesses, collectibles, art, and securities that do not trade actively. When the estate is settled, those assets often have to be sold quickly to pay estate taxes, settle debts, or divide assets among multiple heirs. Forced sales happen at the worst possible time and the worst possible prices. Real estate sold in an estate sale typically trades at a 10% to 20% discount to market value because buyers know the executor is motivated to close quickly. Businesses sold in estate liquidations trade at even steeper discounts because there is no competitive bidding process and buyers can lowball. Let me give you a specific case study that illustrates this dynamic. In 2019, a family-owned auto parts distribution business in the Midwest went through estate settlement after the founder died unexpectedly at age 73. The business had annual revenues of $18 million and EBITDA of $2.4 million. So in a normal M&A process, a business like that would sell for 5x to 6x EBITDA or $12 million to $14.4 million. But the founder had no succession plan. His 3 adult children had no interest in running the business, and they lived in different states. The estate owed $1.8 million in estate taxes, and the business had $3 million in debt that was personally guaranteed by the founder. The estate needed liquidity immediately to pay the taxes and settle the debt. The executor hired a business broker who found a private equity firm willing to acquire the business for $7 million, roughly 3x EBITDA. The children took the deal because they needed the cash and didn't want to manage the business. The private equity firm restructured operations, brought in professional management, and sold the business 3 years later for $16 million, making a $9 million profit in 3 years. That $9 million profit came directly out of the heirs' pockets because they were forced to sell at a distressed valuation. If the founder had created a succession plan, transferred ownership gradually through gifting, and ensured the business could operate independently of him, the heirs would have captured that $9 million. Instead, it went to opportunistic buyers who understood the forced sale dynamic. This pattern repeats across every asset class. Estate sales of art and collectibles happen through auction houses that take 15% to 25% commissions and where buyers know they're bidding against distressed sellers. Farmland and ranch land sold in estate settlements goes for 20% to 30% below comparable market sales because buyers know the family needs liquidity and doesn't have time to market the property properly. This is where the asymmetric opportunity comes in for investors with capital and patience. Estate sales, probate auctions, and distressed asset liquidations are some of the best opportunities to acquire high-quality assets at 50 to 70 cents on the dollar. The heirs need liquidity. They don't want to manage the assets, and they're willing to take discounts to simplify the process and move on with their lives. If you build relationships with estate attorneys, probate specialists, and business brokers, you can get access to these opportunities before they're marketed publicly. And if you can close quickly with cash, you can negotiate even steeper discounts because speed and certainty are worth more to executors than maximizing price. The third mechanism is financial advisor fees and wealth extraction by the financial services industry. When an unsophisticated heir inherits $5 million, the first thing that happens is they get contacted by wealth managers, private banks, and financial advisors offering to help them manage the money. These advisors typically charge 1% to 2% of assets under management annually, which sounds small, but compounds into massive wealth destruction over time. A 1.5% annual fee on a $5 million portfolio costs $75,000 per year. Over 20 years, assuming 7% gross returns, that fee reduces the portfolio's ending value by over $1.2 million. The heir thinks they're getting professional advice, but what they're actually getting is a systematic extraction of 25% to 30% of their wealth over 2 decades. And that's before accounting for the fact that most financial advisors underperform passive index funds after fees. The average actively managed mutual fund underperforms the S&P 500 by 1% to 2% per year after fees. So the heir is paying 1.5% in advisory fees to get investments that underperform by another 1% to 2%, resulting in a total performance drag of 2.5% to 3.5% annually. Over 20 years, a 3% annual performance drag turns a $5 million inheritance into $9 million instead of $19.3 million if it had been invested in low-cost index funds. That's $10 million in destroyed wealth, not from bad luck or market crashes, but from fees and underperformance. The fourth mechanism is behavioral. Heirs who inherit significant wealth without having earned it themselves overwhelmingly make poor financial decisions. They upgrade their lifestyle immediately, buying larger homes, luxury cars, and taking expensive vacations. They quit their jobs or reduce their work hours, eliminating their primary source of income. They make high-risk investments in businesses, startups, or speculative assets because they believe they can turn their inheritance into even greater wealth. The data on this is brutal. A study by Ohio State University found that people who receive an inheritance of $150,000 or more are more likely to be in debt 5 years later than people who receive no inheritance at all. The psychological mechanism is simple. The heir views the inheritance as found money rather than earned capital, which lowers their risk perception and increases their willingness to spend. Let me break down the typical psychological pattern that destroys inherited wealth, because understanding this pattern will help you avoid it if you're an heir, or recognize it if you're looking to acquire assets from distressed heirs. Stage 1 is euphoria. The heir receives the inheritance and immediately feels wealthy. They start imagining all the things they can now afford. They tell friends and family about the windfall, and they begin making purchase decisions based on their new net worth rather than their ongoing income. A person who was living on $100,000 per year suddenly has $2 million and starts thinking like a millionaire. Stage 2 is lifestyle inflation. The heir upgrades their living situation, maybe buying a larger home or a vacation property. They buy a luxury car or two. They start traveling internationally, eating at expensive restaurants, and buying designer clothes. These expenditures feel justified because they're using the investment returns from the inheritance, not touching the principal. But here's the math that destroys them. If you inherit $2 million and invest it at 7% gross returns, you're generating $140,000 per year before taxes. After paying 1.5% in advisor fees and 20% capital gains taxes on realized gains, you're netting maybe $90,000 to $100,000 per year. If your previous lifestyle cost $60,000 per year and you upgrade to $120,000 per year, you're now spending more than the inheritance generates. You're eating into principal without realizing it. Stage 3 is the investment phase. The heir, seeing their principal shrink or feeling guilty about not being productive, decides to put the inheritance to work. They invest in a friend's startup, they buy a rental property or two, they get pitched on a franchise opportunity or a real estate development deal. Most of these investments are made with emotion rather than analysis, and the heir lacks the experience to properly evaluate risk, underwrite deals, or negotiate terms. The startup fails and the capital is lost. The rental properties are purchased at inflated prices and generate negative cash flow. The franchise underperforms projections, and the real estate development deal turns into a legal nightmare. Within 3 to 5 years, the heir has lost 30% to 50% of the inheritance on bad investments. Stage 4 is the panic. The heir realizes they're running out of money faster than expected. They cut expenses, but it's too late. The lifestyle inflation is locked in through mortgage payments, car leases, and private school tuition for their kids. They can't downsize without taking losses on assets they overpaid for, and they're now facing the psychological burden of having squandered a generational wealth opportunity. Stage 5 is the liquidation. The heir sells assets at distressed prices to cover shortfalls. They pull money out of retirement accounts early, paying penalties and taxes. And within 10 years of receiving the inheritance, they're back to living paycheck to paycheck with nothing to show for the windfall except debt, regret, and a lesson learned the hard way. This pattern is so common that estate planners have a term for it: sudden wealth syndrome. It affects lottery winners, pro athletes, entertainers, and heirs equally. The only difference is that heirs often have family connections and social pressure that make the syndrome worse because they feel obligated to help relatives, invest in family ventures, or maintain appearances. This is compounded by social pressure. Friends, family members, and acquaintances suddenly have investment opportunities, business ideas, and requests for loans. The heir, feeling guilty about their unearned wealth or eager to prove themselves, starts writing checks. Most of these ventures fail, and the capital is permanently lost. The fifth mechanism, and this is the one that nobody talks about, is the real estate liquidation wave that is about to hit the market. Baby boomers own approximately 32 million homes in the United States, representing over 40% of all owner-occupied housing. As boomers age and pass away, those homes will be inherited by Gen X and millennials who, in most cases, already own their primary residences and do not need or want their parents' homes. The result will be a flood of inherited real estate hitting the market over the next 15 years. Heirs will sell because they don't want to manage rental properties, they live in different cities or states, or they need liquidity to pay estate taxes. This will create sustained downward pressure on housing prices, particularly in regions with aging populations and limited job growth. Let me break down the geography of this liquidation wave because it's not uniform across the country. The heaviest concentration of boomer-owned real estate is in the Sun Belt states where boomers retired: Florida, Arizona, Nevada, and parts of Texas and the Carolinas. These markets will see the largest increase in supply as heirs liquidate vacation homes and retirement properties. Florida alone has over 4.5 million homes owned by boomers, many of them condos and single-family homes in retirement communities. When those properties hit the market, they'll be competing with new construction, with other estate sales, and with boomers who are downsizing but still alive. The result will be sustained oversupply that keeps prices flat or declining for years. The second wave will hit the Rust Belt and Midwest markets where boomers aged in place in homes they bought in the 1970s and 1980s. These are markets like Detroit, Cleveland, St. Louis, and smaller manufacturing towns where population has been declining for decades. When boomer homeowners die and heirs inherit properties in markets with shrinking populations and limited job growth, those homes will be nearly impossible to sell at any price above the cost of demolition. This creates opportunities for investors who can acquire properties for pennies on the dollar, either to hold as rentals or to land bank for future development when the demographics shift again. But it also creates a long-term headwind for housing prices in these regions because supply will exceed demand for at least a decade. The third category is high-value urban and coastal markets like New York, San Francisco, Los Angeles, and Boston. Boomers in these markets own homes worth $2 million to $5 million or more, and when they die, the estate tax implications force heirs to sell. A $4 million home in San Francisco triggers estate taxes if the total estate exceeds the exemption limit, and heirs who live out of state have no interest in managing a high-maintenance property remotely. These sales will create opportunities for well-capitalized buyers to acquire prime real estate in supply-constrained markets at discounts, but the transaction volume will also put downward pressure on prices, particularly in markets where demand is softening due to work-from-home trends and urban flight. The opportunity here is generational. Investors with cash or access to capital will be able to acquire properties at discounts as heirs liquidate. This is not a 2008-style crash where banks are foreclosing and dumping properties. This is a slow, steady increase in supply driven by demographic inevitability, and it will create opportunities for patient investors to build real estate portfolios at below replacement cost prices. Now let's talk about the specific categories of assets that are being transferred and why each one creates a different type of opportunity. The largest category is residential real estate, which represents approximately $35 trillion of the $84 trillion being transferred. Most of this real estate is located in suburban and exurban areas where boomers raise their families. Much of it is in states with aging populations like Florida, Arizona, and the Northeast. And much of it will be sold by heirs who do not want to relocate or manage properties remotely. The second category is financial assets, stocks, bonds, mutual funds, ETFs, and retirement accounts. This represents approximately $30 trillion. When heirs inherit these assets, they face a decision: hold or sell. Most will sell, either because they need liquidity, because they're uncomfortable with the portfolio allocation, or because their financial advisor recommends repositioning into fee-generating products. This creates selling pressure in the stock market, particularly in individual stocks and sector-specific holdings that boomers favored. If you track the sectors where boomers are overweight, energy, financials, utilities, and large-cap value stocks, you will see sustained outflows as heirs liquidate and reallocate. The third category is privately held businesses. There are over 12 million small businesses in the United States owned by boomers, and more than 70% of those owners have no succession plan. When the owner dies, the business either gets sold, liquidated, or passed to heirs who have no experience running it. Most of these businesses will be sold at distressed valuations because the heirs do not have the skills or interest to operate them. This is one of the most asymmetric opportunities in the entire wealth transfer. Small businesses with stable cash flows, established customer bases, and competent management teams will be available for acquisition at 2x to 4x EBITDA, multiples that are 50% below what private equity firms pay for similar businesses. If you have operational expertise and access to capital, buying cash-flowing businesses from distressed estates is one of the highest return strategies available. The fourth category is collectibles, art, jewelry, classic cars, and other tangible assets. Boomers accumulated enormous collections of items that have significant value but limited liquidity. When heirs inherit these collections, they almost always sell because they do not have the expertise to value them, the connections to find buyers, or the interest in maintaining them. Estate sales and auction houses are flooded with these items, and savvy buyers can acquire high-value collectibles at fractions of retail prices. This requires specialized knowledge, but for those who have it, the returns are exceptional. Now let's connect this to the broader macroeconomic environment because the wealth transfer is not happening in a vacuum. It is happening at a time of rising interest rates, elevated asset valuations, and significant stress in the banking and real estate sectors. This creates a perfect storm where heirs are forced to liquidate assets into a market that is less liquid and more volatile than the market their parents invested in. When boomers bought homes in the 1970s and 1980s, mortgage rates were high, but home prices were low. They paid 12% to 15% interest, but the purchase price was 2x to 3x their annual income. Today, their heirs are trying to sell those homes into a market where mortgage rates are 7%. But home prices are 5x to 8x the median income. The buyer pool is smaller, the affordability is worse, and the transaction times are longer. Similarly, when boomers bought stocks in the 1980s and 1990s, the S&P 500 was trading at 10x to 15x earnings. Today it trades at 20x to 25x earnings. Heirs who inherit stock portfolios and sell into this market are selling at valuations that are unlikely to be sustained if the economy enters a recession or if corporate earnings decline. This creates a timing risk for heirs and a timing opportunity for buyers. If you are positioned with cash or dry powder when the liquidation wave accelerates, you will be able to acquire assets at distressed prices from motivated sellers who need liquidity and do not have the luxury of waiting for better market conditions. The 3 asymmetric strategies to position yourself for this wealth transfer are specific, actionable, and designed to put you on the receiving end of the redistribution rather than the losing end. Strategy 1 is to build cash reserves and access to capital specifically for distressed asset acquisition. This means holding 20% to 30% of your investable assets in short-term treasuries, money market funds, or liquid securities that can be converted to cash within days. The goal is to have dry powder available when estate sales, probate auctions, and distressed business sales hit the market. You also need to establish relationships with estate attorneys, probate specialists, and business brokers who can give you early access to opportunities before they are publicly listed. The best deals never make it to the open market. They are sold privately to buyers who have existing relationships and can close quickly. Strategy 2 is to focus on cash-flowing real assets that heirs do not want to manage. This includes rental properties, small businesses, farmland, and royalty interests in energy or mineral rights. These are assets that generate income but require active management or specialized knowledge. Heirs overwhelmingly prefer to sell these assets and convert them to liquid securities or cash, which creates pricing inefficiencies. If you have the expertise to manage rental properties or operate small businesses, you can acquire these assets at 30% to 50% discounts to their income-producing value. You buy for cash flow, you hold through the dislocation, and you exit at normalized valuations when the market stabilizes. Strategy 3 is to avoid the wealth destruction mechanisms that will consume most heirs. If you are expecting an inheritance, you need to educate yourself now on estate planning, tax optimization, and asset allocation. You need to avoid high-fee financial advisors and instead use low-cost index funds, direct ownership of real estate, and tax-advantaged accounts. You need to resist lifestyle inflation and maintain the work ethic and discipline that builds wealth rather than consumes it. And you need to view your inheritance not as found money to be spent, but as capital to be preserved and compounded over decades. The simplest way to avoid wealth destruction is to follow the 4% rule. Never spend more than 4% of your inheritance annually. If you inherit $2 million, that means living on $80,000 per year from the portfolio while allowing the principal to compound. This ensures that the wealth is preserved and grows over time rather than being consumed within a decade. Here's your action plan for this week, and you need to execute on this while the wealth transfer is still in the early stages. Step 1, if you are expecting an inheritance, have a direct conversation with your parents or relatives about their estate plan. Ask if they have a will, a trust, and a succession plan for any businesses or properties. Most families avoid these conversations, but avoiding them guarantees that you will be unprepared when the transfer happens. Schedule a meeting with your parents and their estate attorney. Review the documents, understand the tax implications, and identify any gaps in the plan that need to be addressed now, not after someone dies. If your parents don't have an estate plan, offer to help them create one. This is not about being greedy or morbid. This is about protecting the family from unnecessary taxes, legal fees, and conflicts. A properly structured estate plan can save 20% to 40% of the estate value that would otherwise be lost to taxes and administrative costs. Step 2. If you are an investor, start building your cash reserves and establishing relationships with estate attorneys and probate specialists in your area. These relationships take time to develop, and you want them in place before the distressed opportunities start appearing. Attend probate auctions. Introduce yourself to estate liquidation companies. Join real estate investor groups that focus on estate sales and distressed properties. The goal is to become a known buyer in your market so that when an executor needs to liquidate assets quickly, you're one of the first calls they make. This is not about being predatory. This is about providing liquidity to families who need it and being compensated for taking on assets that heirs don't want to manage. Step 3. Educate yourself on the specific asset categories where you have expertise. If you know real estate, focus on estate property sales. If you know small businesses, focus on business acquisitions from retiring or deceased owners. If you know collectibles, focus on estate auctions. Specialize in one category and become the go-to buyer in your market. This requires building specialized knowledge. If you're focused on real estate, you need to understand estate sale dynamics, title issues, probate timelines, and how to structure offers that can close quickly. If you're focused on businesses, you need to understand valuation, due diligence, transition planning, and how to structure deals that protect the heirs from ongoing liability. The investors who make the most money in distressed situations are not generalists. They're specialists who can move quickly because they've done the work in advance to understand the asset class in the process. Step 4. Avoid high-fee financial products and advisors. If you are managing your own wealth or an inheritance, use low-cost index funds, direct real estate ownership, and tax-advantaged accounts. Do not pay 1% to 2% annually for advice that you can get for free or for a flat fee. Interview fee-only financial planners who charge by the hour or by the project, not based on assets under management. Get a second opinion on any investment recommendation. Be skeptical of complex products, structured notes, variable annuities, and anything that pays a commission to the person recommending it. The financial services industry makes billions extracting value from unsophisticated heirs, and the only defense is education and skepticism. Step 5. Stay informed. The wealth transfer is a 25-year process, and the pace will accelerate as the boomer generation ages. Monitor estate sale listings, probate filings, and business for sale marketplaces in your area. The opportunities will become more frequent and more obvious as the decade progresses. Set up Google alerts for estate sales, probate notices, and business liquidations in your target markets. Subscribe to industry newsletters and join online communities where distressed opportunities are discussed. The wealth transfer is not a one-time event. It's a multi-decade process. And the investors who capture the most value are the ones who stay engaged, stay informed, and stay ready to act when opportunities appear. Here's the question I want you to answer in the comments, because this is where the conversation becomes valuable. Are you positioning yourself to acquire assets from the wealth transfer, or are you on the other side as an heir trying to preserve what you inherit? And if you're an heir, what specific steps are you taking to avoid the 70% wealth destruction rate? I read every comment, and the collective intelligence of this community is one of the most powerful resources we have for navigating what's coming. If you found this breakdown valuable, if you understand why this is the largest wealth redistribution in history, and why being prepared means the difference between building generational wealth and losing it, then I need you to do 2 things. First, smash that subscribe button and turn on notifications, because I'm tracking the wealth transfer data, estate sale trends, and distressed asset opportunities in real time. As the opportunities emerge, you will be the first to know. Second, share this video with anyone who is either expecting an inheritance or looking to build wealth through strategic acquisitions. The $84 trillion is transferring whether you're ready or not. The only question is whether you're positioned to capture it, or whether you're going to be one of the 70% who loses it within a generation. The great wealth transfer is here, the opportunities are asymmetric, and the decisions you make in the next 12 months will determine which side of the transfer you're on. I'll see you in the next one. Stay sharp, stay informed, and stay ahead of the curve.